Hey, welcome back. Today we're talking about how to get a real estate investment loan. So are you looking to get involved in real estate investing, but you don't have the cash on hand to make it happen? Well, that's what we're going to be talking about in today's videos, the different kinds of real estate loans that are out there and how to get yourself set up properly for success in getting one of them. So stay tuned. One of the things we want to take a look at first is the different kinds of loans that are available for you as a real estate investor. So there are conventional loans, and that's basically going to the bank and coming up with a down payment and qualifying and jumping through all the hoops that they require to get a loan. That's the most conventional, the normal way to do it. There are also other kinds of loans like hard money loans. Now these are businesses and individuals that lend money as their business. They're almost like loan sharks. Now that's kind of a negative terminology, but that's the idea. These people will loan you the money. They're not as stringent as the big banks. However, they tend to charge a lot more for the money because they provide it a lot faster, a lot easier than the banks might. But still, these folks are going to be taking a very hard look at the property itself to make sure that if you default on the loan, they can take the property back and they can get their money back quickly and easily. So they're not looking so much at you and your financial situation, but they're definitely looking at the property itself. And then the third kind of loan that you can be looking at is a private loan from a private individual. And this could be in the form of just a general loan, somebody lending you money and getting a return on their investment, or it could be somebody coming on board as a partner, a joint venture partner with you to actually do the deal. So there you have it, conventional type loans, hard money loans, and private loans. Those are three main kinds that you can look at. There are a few other ones out there like government-backed loans. So if you're in the States, if you're a veteran, there's the VA, there's small business type loans, but again, typically those are for business type deals or commercial type properties, but there are those kind of options as well. The next thing we want to take a look at is your own personal financial situation and your credit worthiness. How worthy are you of somebody loaning you money? So especially if you're going to be dealing with a conventional lender or the government, they're going to take a really close look at you and your credit score and your debt service ratio and all of these kind of things to make sure that they are comfortable loaning you the money. So be prepared for that. Find out what they're going to require ahead of time so it doesn't hit you by surprise. And ideally, when you're going to go for one of those loans, go in with everything ready to go right off the get-go. A good mortgage broker is a great resource for you in this scenario because they can let you know ahead of time exactly what's required and help you gather all of that information. So make sure you understand that. And if you're a little bit shaky, if you got a few credit challenges, try to get those tidied up as much and as quickly as possible to get your credit level to the point where lenders are comfortable loaning you money. All of this kind of reminds me of one of my clients, Matt. And Matt was, like myself and a lot of us, self-employed. So banks weren't a big fan of Matt's at the beginning, that's for sure, because they prefer people that have steady jobs, especially government employees or people that have good union type jobs. Those are the folks that they really like to loan money to because they're a safe bet. So because self-employed people have a much higher bankruptcy rate than union employees, banks aren't so comfortable about loaning us money. So what Matt did was very, very smart. He got started and really focused on his business, got it to a point where it was generating great income for himself and he had a strong financial statement. At the same time, he started doing flips and he would take the profit from those flips and put that in the bank to kind of create his own little treasure chest there. So after a while, it got to the point where it was a no-brainer for the banks to loan him money because he had a lot of money already. And that's when the banks tend to like to loan you money, is when you don't really need it. So it's funny how that works, but that's something that you can look at if you're in this for the long term, if you're self-employed, is really tidy things up so that you're a much more attractive prospect for the banks. Next step is you want to do some research. You want to take a look at who are the potential lenders in your area. So don't just think about the big banks. Yes, go for it there, but also look at credit unions, also look at hard money lenders, also look at private money lenders. A good, like I mentioned before, a good mortgage broker can be a godsend for you because they've got access to traditional lenders, the conventional big banks. They've got access to the credit unions. They've got access to private lenders, hard money lenders sometimes, mix, REITs, all these different things. They've got a lot of access. A good mortgage broker is worth their weight in gold. So they can help you evaluate the different options that are available for you as well. Step number 4, prepare a solid business plan. So banks and lenders feel a lot more comfortable loaning you money if they feel confident that you know what the heck you're doing. And a good way to show people that you know what you're doing is to prepare a really good, solid lender package. My good friend Ken Beaton, for years, had an amazing lender package that he would take to the banks when he was looking to finance a property. And he would provide this to the banks, and they would be blown away because he already had every single thing they could possibly want in a very neat, tidy, and well-organized format. So just the impact that made initially, right off the get-go, compared to everybody else that was asking for a loan, brought him up head and shoulders over everybody else. It made the bankers much more comfortable and much more likely to make Ken the loan that he was looking for. So you can do the same thing. Find out what it is that the bank is going to require and provide it to them in a very attractive format. And I would highly recommend that you actually maybe invest a few bucks, hire somebody on Fiverr to help you out with this, but create some nice, clean, crisp images, PDFs, that sort of thing that you can give to people, and then print them out full color and give the banker not only a digital copy, but a physical copy of everything that they're going to be looking for. And the good thing is, once you've created this once, all you have to do is update it as you're adding more properties to your portfolio. You really only have to do the work heavy duty one time, and then you're good to go forever. Another thing you want to look at is collateral. What does collateral mean? Well, this is the physical asset or assets that the bank or the lender can grab if you stop making the payments, right? So they want some security on their loan. So collateral is the security. And typically, the collateral is going to be the property that you're purchasing itself. However, if you want to give yourself an extra boost, an extra chance at success, you might consider offering to add on additional collateral to that loan application. So for example, if you're trying to get a loan for a single family home and you want a mortgage for $200,000 for easy numbers, and the property itself is worth $250,000, then they might be looking for $50,000 as a down payment plus in order to give you a $200,000 loans. But if you're able to show them that you're willing to put a second mortgage on another property in their name to provide extra security for their loan, that'll make them feel much more comfortable about lending you the money. This is something that's really, really handy, especially if you're dealing with hard money lenders, private lenders, that sort of thing. Now, whichever way you go with getting loans, you have to be kind of careful because it is a little bit of a risky business leveraging a property. What are some of the challenges that people run into sometimes? Well, they underestimate how much it's going to cost to renovate a property. So they end up kind of over leveraging themselves on the purchase of the property. Then they have no extra cash to finish the renovations, and they get stuck in a very, very difficult place. So make sure that when you're getting, you're doing your due diligence, that you understand what the condition of the property really is, and don't just rely on a simple home inspection. I would suggest that you get a qualified professional to take a good look at the property, a contractor, somebody like that, to give you a really good idea of what's really involved with that property. All right, and then also be prepared for things to take longer than you think they might. So if you're anticipating a renovation is going to take 2 months, make sure that you've got enough financial wherewithal to last for 4 or 6 months in the worst case scenario. So always hope for the best, but prepare for the worst, so that way you're not overextended on your loan. That's a way that a lot of people have gotten in trouble with these kind of mortgages and loans. So one of the things you could really look at if you're looking at how to get a loan for investing in real estate is to partner up with somebody else and join forces. So if you're a little bit shaky on the finances, or if you don't have the capital required for the down payment, or your credit rating is not as high as the bank would like, or you're self-employed, or your debt service isn't where they like it, consider joining forces with a joint venture partner or an investor partner who comes on board and helps you out with the money for the down payment, with the credit to get qualified for the financing. This is a perfect way to join forces and create a win-win scenario. You win because you're able to do the deal. even though you couldn't do it on your own. Now, by joining forces, you can do it. Your joint venture partner wins because they're able to get into real estate investing without having to do all the hard work by themselves, without having to go through the learning curve that you've already gone through. It's a shortcut for them to get involved with real estate without the hassles and the headaches. So take a look at that. And when you are looking at raising private capital, I highly recommend you start with your inner circle first. Your friends, your family members, your coworkers, business associates, people that you have a pre-existing relationship with. Super important, because this is the fastest, easiest, and safest capital that you can access. Speaking of accessing this kind of capital, if you'd like to do that, I've got a good resource for you. It's my book, The Money Partner Formula. Walks through my entire process of attracting private lenders and joint venture partners. So instead of you chasing after them, they're coming to you, pre-educated, pre-qualified, predisposed to invest in your deals. This is a great way for you to raise 6 figures in a matter of weeks, and even 7 figures in a matter of months, like literally hundreds of other real estate investors just like you have done in the past. Good news is the price is right. It's free. You can get a copy. Click on the link below or go to investorattractionbook.com. Grab your copy today.